The car industry is experiencing a massive downturn, the likes of which we've not seen before. Early 2023 indicators suggest this is just the beginning. UBS and Cox automotive analysts highlight a significant vehicle surplus triggering an intense price competition. This downturn could potentially eclipse the impacts of the financial crisis. Car dealerships face challenging times ahead. However, for U.S. drivers who've struggled with soaring car prices, a break is on the horizon. Supply in the U.S. auto sector now vastly overshadows demand, resulting in a sharp price drop in 2023's latter half. Various factors in recent years have made cars less accessible to U.S. consumers. Used car values shot up by over 40%, and for the first time, new cars often cost more than $50,000. COVID-19 intensified the dilemma, hindering production lines and causing a worldwide chip shortage. This led to scant car stocks and steep prices for more than 2 years. Car manufacturers found that lower stocks upped their profits, but this proved unsustainable when consumer spending declined. It's projected that 2023 will be the year when car prices substantially decrease. Numerous car models have slashed their prices by about 25% to enhance sales, even if it affects profits. Clark Howard, a respected financial commentator, likens the car sector's trajectory to a turbulent roller coaster. Dealers used to inflate prices beyond the suggested retail cost, but now most cars are heavily marked down. Fresh data from auto supplier Manheim indicates that May was the second straight month where new car sales prices were less than their retail values in almost 2 years, with increasing incentives from manufacturers. The ongoing car market slump predicts a continued drop in car prices throughout the year. Manheim's data showcases a consistent price decrease from peak levels, hinting at a possible significant price crash. In May, the index declined yet again, currently 0.3 points beneath January's data. Frey notes an 8-month streak of year-over-year reductions, averaging 8.3%, with the trend showing no signs of abating. The current downturn in the car market is drawing parallels with the 2008 financial crisis, but with a more intense fall. In contrast to the 2008 crisis, which saw a 37% dip in prices over 16 months, the present decline is steeper. Post the pandemic's peak in January 2022, both new and used car prices have tumbled swiftly. In the previous month alone, vehicle sales reduced by 8%, and Manheim's data confirms this declining trend both monthly and annually. Although some cars have had their prices slashed by up to $15,000 this year, these reductions pale in comparison to the significant price surges during the pandemic's zenith. The combination of dwindling car prices and ascending interest rates is squeezing dealers' profit margins. The automobile industry has been undergoing noticeable shifts recently. Rising vehicle prices, accompanied by a limited range of budget-friendly options, have considerably influenced consumer sentiment towards new car purchases. To give some perspective, the financial burden of owning a new car is illustrated by the average monthly payment, which currently stands at a considerable $716. In contrast, the expenditure for second-hand vehicles is a slightly more manageable $526. This financial dynamic has steered Americans toward a different strategy: longer retention of their existing vehicles. This approach is likely a combination of economic prudence and apprehension about diving into a market dominated by high prices. The ripple effect of this behavior has been quite striking. Today, the roads of America are dominated by older vehicles. In fact, the average age of cars has reached a milestone 12.5 years. The implications are clear. Many Americans are postponing the replacement of their vehicles, opting instead to maximize the lifespan of their current ones. This sentiment was particularly evident in 2022, with a remarkable 55% of consumers bypassing the opportunity to buy a new car. As we progress through this year, initial signs suggest that this trend is not only continuing but potentially intensifying. Zooming out to analyze broader consumer behavior, a discernible pattern emerges. It seems that the uncertainty and economic pressure of the current times have redirected the focus of consumers. There's a heightened emphasis on fundamental needs and necessities. A larger chunk of disposable income is being funneled towards critical expenditures like housing, utilities, and health care. This pivot in spending priorities has inadvertently led to a decrease in allocation to other sectors, particularly the automobile and related industries. Consequently, spending on cars, replacement parts, fuel, and other associated commodities has seen a downturn. Diving deeper into the specifics of the car market, the used car sector offers a telling narrative. The market dynamics that had driven up used car prices, often referred to as the used car bubble, has deflated. Simultaneously, new car prices are teetering on the edge, poised for what many experts believe will be a significant decline. While potential buyers might view this as an opportune moment, the scenario is far from ideal for dealerships. Howard's commentary accentuates the tumult dealerships are grappling with. Amplifying these concerns, a study by UPS sheds light on the looming challenges. Forecasts indicate an imbalance wherein car production might outpace sales by an unprecedented 6% this year. In real terms, this discrepancy could mean an oversupply of around 5 million vehicles. Addressing this inventory glut will necessitate aggressive pricing strategies, with dealerships likely having to slash prices considerably to stimulate sales and clear their bulging stockyards. Cox Automotive has pinpointed several automobile brands grappling with excessive inventory, including Buick, Jaguar, and Jeep, with stocks surpassing double their ideal levels. Chrysler, Ram, and Infiniti are hovering close to double their desired stockpile, while Lincoln, Dodge, and Ford have a surplus of around 35%. Such excess stock poses additional challenges for dealers and manufacturers alike. Despite the market's call for affordable options, manufacturers have been offloading high-end variants on dealerships, putting them in a tough spot. UBS's analysis forecasts an impending price battle within the electric vehicle, EV domain, which is expected to soon spill over to traditional combustion engine vehicles by late 2023. At the forefront of these price reductions is the EV behemoth, Tesla. They've posted concerning declines in Q1 earnings owing to shrinking profit margins, reporting profits of $2.5 billion, marking a fall of nearly 25% year-over-year. Elon Musk, during a discussion with market analysts, attributed these price slashes to larger economic factors. The intent was to drive sales volume, even if it meant thinner profit margins. External economic pressures, such as recession fears and looming unemployment, are causing potential buyers to delay significant expenditures like car purchases. This pricing strategy, though, has taken a toll on Tesla's operational profit margins, declining to 11.4% from the prior 16%. In an aggressive move to bolster its sales, Tesla has taken a bold step by slashing its prices. While this approach may invigorate the company's sales numbers, there's a catch. It puts a squeeze on their profit margins. Such a decision isn't taken lightly and underscores the pressures automakers face in an ever-evolving market landscape. Tesla, a titan in the EV sector, is joining a growing list of automakers resorting to discounts and promotions. Their hope? To catalyze sales momentum before the foreboding shadows of a potential economic downturn become a reality, further curtailing consumer appetite for new vehicles. This overarching strategy among manufacturers is a reaction to broader market signals suggesting dwindling demand in the near future. Kelley Blue Book, a trusted source for car valuations, has recently shared data that paints a telling picture of the current state of the car market. Their numbers reveal that non-luxury new vehicles saw their average transaction prices retract to $44,750 last month. To put that in perspective, this means a significant dip of $6,250 since the start of the year. However, the electric vehicle segment, where Tesla prominently sits, tells an even more dramatic story. The figures are staggering. The average transaction price for a new electric vehicle in June was pegged at $55,089. When you crunch the numbers, that's a sharp decline of 7.5%, or $4,464, just from May's average. The trend becomes even more pronounced when contrasted against the previous year, with June's figures being a whopping $10,096 less than the same month in 2022. These data points not only underscore the current volatility in the car market, but also hint at a broader recalibration in consumer behavior and expectations, particularly in the high-stakes electric vehicle segment. It remains to be seen if Tesla's bet on price reductions will pay off in the long run, especially when balanced against the challenges to profitability. This year is witnessing a decline in new vehicle prices, offering a reprieve for consumers after prolonged periods of scant supply and escalating costs. For those contemplating a new vehicle, the timing could be fortuitous. Yet potential buyers should proceed with prudence, considering this downtrend is still in its early stages. The prices for new vehicles might plummet further before reaching equilibrium. While such a decline in the car market is a boon for buyers, it translates to substantial financial hits for manufacturers and dealers, primarily due to overstock challenges and deep price cuts. Nonetheless, optimism persists within the sector. Advances in electric vehicle innovations, heightened safety protocols, and the introduction of more fuel-efficient engines all indicate a promising horizon for both producers and consumers. Even if the upcoming months are characterized by volatility, the automobile industry has historically demonstrated its resilience. A resurgence appears to be in the offing,